What's a PFIC? This short video covers the definition of a passive foreign investment company, or PFIC, under U.S. tax rules. It's a continuation of a summary video on PFICs. To view that video, click here. Let's dive deep into the definition of PFIC. There are two requirements and two items for relevance. First, only a foreign corporation can be a PFIC. A U.S. entity is not itself a PFIC, but may own shares of a PFIC. Corporation status is determined under U.S. income tax rules. I'll provide a link here to a video on business entity classification when that video is available. The second requirement for PFIC status is that the foreign corporation's passive income is 75% or more of the corporation's total gross income, or passive assets are 50% or more of total assets. More on this in a moment. Third, the U.S. person's interest must be an interest in equity. Usually this means owning shares of stock issued by the entity itself, not by some other entity. If the holding is something else, like bonds, then the PFIC rules don't apply to that U.S. person. Characterizing what the U.S. person owns is critical and seems to be a source of confusion for many people. You need to know what you bought. For more guidance on how to treat particular investments, see Chapter 14 of my book, Income Tax in the USA, available on Amazon.com. Finally, PFIC status is irrelevant for foreign persons. PFIC status only affects U.S. income tax, and only that of citizens and residents. Resident can include individuals, corporations, estates, and trusts. This aspect of PFIC is covered lightly in the top-level video I mentioned earlier. The income test for PFIC compares the foreign corporation's passive gross income to its total gross income. If the passive income is 75% or more of total gross income, then the foreign corporation is a PFIC for the year. Gross income is determined under U.S. tax principles. Gross income is gross receipts plus other income less cost of goods sold. For a discussion of how to determine gross income, see Chapters 11 through 15 of my book, Income Tax in the USA. The asset test for PFIC compares passive assets to total assets. Comparisons are based on tax basis, but there's a limited election that modifies this. If 50% or more of the corporation's assets are passive, then it is a PFIC. Passive assets include assets producing passive income, assets that would produce passive gain if sold, and assets that produce no income. Passive assets include specifically cash, bank accounts, land, stocks and bonds, and most rental assets. There are two key modifiers, though. First is the 25% look-through rule I'll discuss in a minute. Second, debt owed to the foreign corporation by a related party may be partly or wholly considered not passive under the Subpart F rules for determining what is passive. There are exceptions to the definition of passive income and passive assets that don't often apply to the sort of company that's usually a PFIC. These include same-country related party interest, dividends, rents, and royalties, and active trade or business rents and royalties. For details on these, see the Subpart F videos, the first of which is linked here. There's also a startup exception designed to keep an operating company from being treated as a PFIC in its first year. A key aspect of PFIC definitions is the 25% look-through rule. A foreign corporation's assets and income are determined by treating it as directly owning its proportional share of the assets and income of any foreign corporation of which it owns at least 25%. The shares of that lower-tier corporation are ignored, as are any dividends from the lower-tier corporation. Thus, if a U.S. person owns a few shares of Alto, and Alto also owns 30% of Bajo, both of which are foreign, then Alto's assets are treated as excluding the shares of Bajo, but including 30% of Bajo's assets. Similarly, Alto's gross income is treated as excluding dividends from Bajo, but including 30% of Bajo's gross income. An additional exception applies after 1997. If a foreign corporation is considered a controlled foreign corporation, or CFC, on a particular day, then it is not a PFIC for that day with respect to a 10% or more U.S. shareholder. It can still be a PFIC for other shareholders. For more on CFCs, see the Subpart F video linked here. Let's recap the definition of a PFIC. It is any foreign corporation, some shares of which are owned by U.S. persons, that meets either the passive income test or the passive asset test. Passive means investment-type income or assets. There are some exceptions. A foreign corporation also looks through its 25% or more subsidiaries, treating itself as owning part of their assets and earning part of their income. For more on PFICs, see the overview video linked here. I hope you found this useful, and thanks for learning with me.